Hey guys, today I'm going to show you how you can make money off of existing shares through an option strategy called covered call. If you're an old subscriber, welcome back. If you're a new subscriber, especially from my Trevor Milton videos, stick around. This channel is not only about spilling tea, but it's mainly about making more money and becoming financially independent. Let's get started. First, you have to own 100 shares of a company. Today's example, ZEO is a company I own about 800 shares on. I'm very bullish. They are a software company that helps other companies turn their business model into subscription-based services. So I think that will do well in the future. I'm going to show you how to do it in Robinhood since a majority of you traders out there are using Robinhood. Let's just do an example for one of them. So the price of Zora is about $9.44. So what we want to do is sell a call October 16th, about a month out. That's a pretty decent amount of time. So Robinhood is really nice in that they give you the chances of profit. But basically, when we sell a call, we are selling someone else the right to buy the shares at a certain strike price. This is a neutral bearish strategy, meaning you want the stock to stay low slash neutral. You want it to be lower than your strike price, because as long as it's lower than your strike price, you will get to keep the full amount of premium. This is a coupon for another person to buy your shares at what they perceive might be a cheaper price at a future date. So the person buying your call thinks that maybe ZUO could go up to $14 or $15. And then because they have the coupon for $12, they could use it and get it for cheap. If they are benefiting and get to buy your shares for cheap, obviously you will be losing money. So you, as the option seller, need to have confidence that it will not go above whatever strike price you choose. Now, obviously, the lower the strike price you choose, the higher chance it has getting called away, because it's a much less movement to move $2 versus $3 or $4. So you have to balance that risk. Do you want to get paid a little bit more, but for more risk because it's more likely that $9 will hit $11? Or do you want to get paid a lot less, but have more safety because having it hit $13 is less likely than it hit $12? As you can see here, this is the graph of a covered call. The reason a covered call is so good though, so if you look at this graph, if the price of the stock goes above your strike price, your profit is capped. So that is the downside, in that this share is going up, up, up. ZEO is now worth $15, $16, $17. Because you sold a call at this, let's say, $12 level, all you could ever make is $12 per share, and you will lose all of the potential gain on top here. But because you own the call, you're not losing money, you're just losing potential gains. Obviously, if the share price drops, you own the shares, it could drop to zero. Your risk is just the risk of owning the shares. There's no added on risk because you're doing a covered call. Now, is today even a good day to buy or sell a call? Generally, if it is a green day, if ZOL has gone up, then your calls will be worth a little bit more because the price is going up. And when the price is going up, calls are a little bit more expensive, whether you're buying them or selling them. So let's go back to this graph. So we can kind of see this isn't really the best graph. So I'm going to use the TD Ameritrade Think or Swim graph. So this is a graph of ZOO. You can just take a look at how it's been doing. Here it's leading up to an earnings call. It didn't do too well and it's dropped down since then. And it's been very, very flat for actually the past week and a half. There's no indication that it's going to suddenly move. There are no upcoming catalysts. So I think $11, $12 is pretty safe for an October 16th strike date. The way I'm going to play this is I'm setting my expiration date for October 16th, but about 2 weeks in, I'm going to see where the calls are at. If I've made about 50% profit, I will just close them out. And the way you close out a position like this, because you sold to open the position, you basically have to buy back the call to close it. So I actually sold 3 contracts at the strike price of 13 earlier, but now that wouldn't make sense with only a 1 cent return per share. $12 makes a lot more sense, and chance of profit is still 91% with the delta under 15, which is still pretty good. Delta is one of the main factors of determining your chance of profit, whether it's in the money or not. But let's walk through selling this covered call. So if we sell it, you see it's estimating to give us $13 per contract. This is the bid-ask range. If you wanted to get it filled, you can make it a little bit cheaper, take a little bit discount in profit. If you want to be more ambitious, you can try to make a little bit more money. It's going to take a longer time to get filled. 1 contract, 1 share at $13 each. So review order. Oh, this is important to note too. Zero options below $3 trade in 5-cent increments. So you actually can't even write this exact number, which is a little annoying. I would have to put 0.10 or 0.5. It's up to you to decide what is a fair rate. If I put 10 cents here, that means the cheapest I'm willing to fill it for would be 10 cents. If you put it at 50 cents right now, it would never get filled. So 10 cents, you have to kind of take a risk that it could be filled at a discount. But Robinhood will try to find you a better price, so it could still fill from anywhere from 10 cents to 15 cents. And again, it says 10 cents, but you have to multiply it by 100 because each contract represents 100 shares. So yeah, I'll just show you in my TD account that I actually did place this trade. I have 3 Zool calls that I sold. And yeah, since I sold it, theta decay has already given me some gain. That means the call that I sold has already started to drop in value. So if I were to buy that call back, it would cost less. Therefore, that is what my gain is. I also sold 2 contracts to make a covered call on the 200 workhorse shares I own, and that also seems to be on its way to make money. It expires today. I'm probably going to close that out soon. And then this is a neo put that I sold. Selling contracts has really been the most consistently profitable plays I've made. In this month of trading options almost full time, I've done every single play under the sun. I just want to get reps, get a feel of what kind of strategies work for me. And honestly, when I'm doing call debit spreads, naked puts or calls, iron condors, selling puts has been number 1 and selling calls has been number 2. Really, selling gives you the best win rate. Theta decay is in your favor, and I will be making a lot more videos on that. It's a really easy, consistent way to make money. Of course, there are risks, but once you learn all of them, then you can decide for yourself how much risk you want to take. And generally, you can hedge your risks. You just need to be careful and watch your positions fairly closely on a day-to-day basis. That's it for today. Thank you so much for watching. This is Green Knight Trading, where Squires become knights. Stay tuned for more videos on how we can make more money and get that bread.